In simple terms, I will now explain 90/10 investing strategy, its definition, how it works, and its pros and cons. The 90/10 investing strategy is a simple approach to portfolio allocation where an investor divides the investment portfolio into 90% stocks and 10% bonds or other fixed income securities. Here's a simple explanation. The 90/10 investing strategy involves allocating 90% of your investment portfolio to stocks, which are considered higher risk but potentially offer higher returns over long term. The remaining 10% is allocated to bonds or other fixed income investments, which are generally lower risk but offer lower returns compared to stocks. How it works. Investors implementing the 90/10 strategy typically buy a mix of individual stocks or invest in stock mutual funds or exchange traded funds or ETFs to represent the stock portion of their portfolio. For the bond portion, they may invest in bonds directly or choose bond mutual funds or ETFs. The goal is to achieve a balance between growth potential and risk mitigation. Pros. Growth potential. By allocating a larger portion of the portfolio to stocks, investors aim to benefit from the long-term growth of potential stock market, which has historically outperformed bonds over an extended period of time. Diversification. Holding both stocks and bonds helps spread risk across different asset classes. Bonds can provide stability during market downturns, helping to offset potential losses from stocks. Number 3, simple and easy to implement. The 90/10 strategy is straightforward and easy to understand, making it suitable for investors who prefer a hands-off approach to investing. Excuse me. The cons. Number 1, higher volatility. Because the majority of the portfolio is invested in stocks, the portfolio's value may experience greater fluctuations in response to market volatility compared to a more conservative allocation. Number 2, potential for losses. While stocks offer high potential returns, they also come with a high risk. During market downturns, the portfolio's value may decline significantly, especially if the investor has a shorter investment horizon. Number 3, may not be suitable for all investors. The 90/10 strategy may be appropriate for investors with a low risk tolerance or short investment horizon. It's essential for investors to assess their own risk tolerance, investment goals, and time horizon before adopting this strategy. In conclusion, overall, both meaning almost the same, the 90/10 investing strategy can be an effective way for investors to balance growth potential and risk, but is essential to carefully consider personal financial goals and risk tolerance before implementing any investment strategy. If you found this useful, thank you for watching. If you found this useful, please hit the like button and also subscribe. It's useful for me. It's just a metric, but still, I still want to see some subscribers.